My goal today is to kind of give you guys a feel for the basic rules of 1031. And rather than make you an expert, I'd like to kind of teach you guys how to recognize where a 1031 exchange might help you guys sell something or get something sold faster. And so that's really my intent. If there's one thing that you take away here, it's that you basically just need to have the gist of where an exchange might work. And if you have an idea that something may work, the best thing to do is get us on the phone or get one of us on a Zoom call with your client so we can actually walk through your transaction, do all the math and all that kind of stuff, so you don't get into the weeds trying to figure out is that like kind, or how does that work with respect to identification. You don't need to worry about those kinds of nuances. We just want to kind of train you guys so that you can recognize an opportunity where 1031 can make you money. And that's basically the only reason we're here. Does that make sense? Perfect. So with that in mind, I put together just a handful of slides. This is going to give you the basic rules of 1031. And then after that, we can maybe talk about some scenarios that you guys maybe have seen or you anticipate coming up. And we can kind of walk through how those kind of things work as a 1031 exchange and how you can actually use 1031 to double into a lot of transactions. Because if there is one thing, if you're a broker, the greatest thing about a 1031 exchange is that when you have somebody that sells something and they're going to be exchanging into it, you know for a fact that they have a 45-day gun to their head in which they need to identify new replacement property. So you know that you have the absolute inside track in being able to find them a new replacement property and make 2 commissions instead of 1. That's the best thing about 1031 for brokers. But let's go ahead and get started. So, let's see, let me turn this down. What's been called the greatest wealth building tool since that's still left in the Internal Revenue Code? Do you guys have any idea? 1031. 1031 has been around in the Internal Revenue Code since 1921. So it's been around over 100 years. Back in the day, all exchanges had to be done and closed simultaneously. Can you imagine? So you actually had to sell your old property and buy your new property and close everything on the same day. Hard to do in these days of heavy-duty logistics, lots of moving parts, especially with all the disclosures and all the stuff that you guys have to deal with. It's almost impossible to do a simultaneous exchange today. They happen every once in a while, but even if someone comes in and says, I'd like to close this simultaneously, we go ahead and set it up as a deferred exchange, hoping that it'll close simultaneously, but it doesn't really matter. But so 1031 has been, it's often been called the last great wealth building tool still left in the Internal Revenue Code. So the IRS requires you to utilize the services of what in your 1031 exchange? What do you think that is?
A middleman? I don't know.
The sale of your home.
A qualified intermediary. So a qualified intermediary is basically what we do. We're the guys that take the information from your transaction. We'll be the ones that create all the documentation, and then we'll actually set up a trust account for your client, right? Because the IRS allows you to exchange from one qualified property into another one, and they allow you to do it on a tax-free basis because they see it as your client is simply moving their cost basis for tax purposes from one qualifying property to another. But in order to make sure that that's done correctly and the logistics and the I's are dotted and the T's are crossed, they want to make sure that you use a qualified intermediary company. And we're kind of the ones that move the paperwork from one side of the desk to the other and make sure that the money is handled right through a secure trust account. Make sense? So you must use a qualified intermediary. You can't just paper over your transaction and then report it as an exchange. Otherwise, it'll be blown up and they'll throw that exchange out. So you have to use a qualified intermediary like us. So this is an important question. What is held for investment or held for income? Have you guys ever heard those before?
Nope.
I would assume
for investment and held for income, those are the definitions of like kind according to the IRS, right? So the IRS allows you to do an exchange, but any property that's involved in a 1031 exchange has to be like-kind property. And the IRS defines that as either property held for investment or property held for income. Obviously, if you own an apartment building and you get rents, that's property held for income. That's pretty obvious, right? But even if you owned a vacant lot next door that doesn't generate income, it's still technically held for investment. So that opens up the opportunity with respect to what types of properties can be used in 1031, and it makes it much broader. So held for investment or held for income are the two definitions of like kind that the IRS uses. Sound good?
I have a question.
Yeah, give me a shot.
Yeah, I always heard that when they say the like kind, that it had to be, again, the same price or more. Is that true or not true?
You know, it's technically it's not true. Technically, it's not true. So there's going to be a slide here in a minute where I'm going to give you guys the cheater's math to how to figure out the math on a 1031 exchange. Now, the idea that the IRS has is that when you exchange from one property and you go into another and you do it tax-free, the idea that the IRS has is they expect you to replace the whole property, right? So they expect you to take all your equity and all your debt and move that over to the new property. Now, do you have to do that? No. If you want to have a tax-free deal, you do, but you don't have to buy equal or greater in value. It just means that to the extent that you don't trade up and you trade down or you hold back cash, you're going to owe tax on the difference. Does that kind of answer the question?
Yeah. So if, let's say one of our investors had, they sold a house, they had $500,000 in equity. That's what they walked away with.
Right.
Could they buy two properties with that?
Absolutely. Absolutely.
As long as they use all of that equity.
Exactly right. And then if they don't use all that equity, then they would just owe tax on that difference that they held back, right? I'll give you an example. One time I was doing an exchange for a guy and he said, now I got to hold back $25,000 to buy my wife a new Honda. And I told him, I said, yeah, that's going to be the most expensive Honda anybody ever bought. And he says, well, why is that? I said, because you're going to have to pay gain tax on that money before you go down and buy the car. Right.
Oh, yeah.
Okay. So that, and we'll go over a little bit more of the math so you guys get pretty comfortable with kind of figuring out how it is. But, sometimes the smart play, I'll be the first to admit, sometimes the smart play is to pay the tax and move on and not necessarily do the exchange, because it is possible to get too deep in the weeds. And I've seen people that are jumping through all sorts of hoops just so that they don't have to pay $10 in tax, when sometimes that's not the smart play. So what is 180 days? I'm sure you guys know this one, right?
6 months.
Right. So 180 days is the actual total amount of time that you have to do an exchange, right? So back in the old days and before 1984, all the exchanges had to close on the same day. But what happened was there was a case called the Starker case. You guys might have heard about it. There was a guy who's a farmer, and his name was T.J. Starker. And T.J. Starker sold some timberland to a company called Crown Zellerbach up in Oregon. And then once he sold that, rather than taking the cash from Crown Zellerbach, he took a credit on their books. And over the course of the next 5 years, as TJ found a house or a property that he wanted to buy, Crown Zellerbach would buy it and then have it deeded to TJ. And then after 5 years, he reported that as a totally tax deferred exchange to the IRS. You can imagine what they said. You can't do all exchanges have to be simultaneous. You can't do it over a 5-year period. And so they tried to blow it up. But the interesting thing is that TJ prevailed in tax court. And so that's why we now have deferred or delayed exchanges. And the 180 days is the amount of time that the IRS has selected that you actually have in total to actually complete your exchange. So you need to sell a property and then buy however many properties you want to buy. You need to make sure those are all closed. and you can do it all within the 180-day window. Does that make sense? Now, one interesting caveat about this is the actual rule is you have a total of 180 days or whenever your tax return is due to do your exchange. What that means is if you start your exchange late in the year, say if you start your exchange around Thanksgiving, you actually, if you count it out, you actually don't have 180 days before your tax return is due on April 15th. So it is possible that if you start your exchange late in the year, you may actually have to file an extension on your tax return to get the full 180, right? But 180 days is the total amount of time that you have to complete your exchange. So what is 45 days? Anybody have any ideas?
It's a myth.
They have to make their decision in 45 days as to what they want to invest in.
Exactly right. Exactly right. So within 45 days, you need to identify some candidate or target properties you're interested in buying, right? And then whatever you buy within that 180-day window has to be something that you identified within the 45-day identification period. Does that make sense?
So how do you identify that? You have to let the IRS know, hey, this is what I'm going to be purchasing?
No, basically the identification process is just a form. It's a form that we provide you, or we actually have a wizard online where you can actually do it online. But it's just basically a form. And there's rules that you use to identify. Most people use what's known as the 3 property rule, but you just kind of list the properties that you're interested in buying. And then you just provide that you're qualified. Usually you provide it to your qualified intermediary. You guys may find situations where the exchanger actually identifies to you, because technically you just need to identify to somebody, either your qualified intermediary or somebody who's involved in the transaction. So if you're buying, if you have an exchanger who's buying a replacement property through you, technically it's possible that they ID to you. Right? It's just that the identification has to happen within that 45-day window.
So
So
go ahead.
So my question to you is, because this happens all the time where people identify a property and they really want it, and then they try, and then just for some reasons it doesn't work out. So it really is best to identify 3. What happens if you do identify some and then they don't work out? Like, what are we in trouble at that point, or what? How will that work?
Well, the first thing I'll say is that the qualified intermediary is not the policeman of the IRS, right? But the reality is that in a market like this where you don't have lots of inventory, the smart play is to probably wait as far into the 45 days as you can and work like heck to get something teed up so you actually know that you can ID and actually complete the purchase. But the one thing that you can always keep in the back of your mind, as long as you're within that 45-day window, you can always revoke a previous identification and re-identify new property. Does that make sense?
Yeah.
And then
That's good.
That was my question, because I have a client that I just helped sell their house. They ended up, they had another investment property in Arizona. They had to sell it, and then they were running out of time within that 45 time limit. So they ended up buying an Airbnb in Tennessee. So again, my question, that was the same question. What if that didn't work out? Do you just go back to the IRS and file a different property?
Well, if you're within the 45 days, you can identify new property. But once you're past the 45 days, then you're toast. You're a taxpayer. You're going to have to go ahead and report that as a sale.
Oh, wow.
I have
One
a
other
client
thing
right now that's in her 45-day period. She sold her land in Oklahoma pretty quick, and she's moving over here to the Quantico area. She's identified a winery and told me about it, but that's as far as we've gotten. She's only picked 1 property, but her time is ticking. So I guess I'm the identifiee, and I need to write that down somewhere and declare it for her.
Yeah, the other thing is that any identification basically needs to, if you look at the regs, any identification has to be in writing, right? And it has to be otherwise transmitted within the 45-day window, right? So the exchanger has to make that identification and it has to be transferred within that 45-day window. But technically, if you think about it, if you guys are writing a contract and you have a deposit receipt or a purchase and sale agreement that's signed by the seller and dated within that 45-day window, technically you could use that contract as identification, if that makes sense. One other thing you guys might want to think in terms of is when the market gets really tight and there's very little stuff out there for when the inventory is dwindling and it's hard to get something identified. If you need to, I can put you in touch with some people that can actually, they'll work with you as a broker to make sure that you get paid. But these are companies that have institutional or investment grade alternatives. So like, for instance, if you have somebody that had a couple deals and they fell out and they're getting towards the end of their 45 days and you don't know what they're going to buy, you could put them in touch with one of these companies and they could buy like a slice of a Dollar General or a Walgreens or something like that to save their 1031 and you still get paid. So there are institutional opportunities out there like that you could use as kind of a backup plan.
I got a quick question. I'm sorry. It's so if we were to get our investors on a Zoom, would you be willing to teach a class on this for the investors? Because again, I would love to get them on so that way in the future, they could be like, I got one investor who has like 15 properties right now. And I know for a fact he's looking to buy more, but if, this really will push, in my opinion, push them to invest in more properties. So if you have a class for investors, I would love, and again, for every agent in here, guys, you want to, invite your investors so that way, we can get them rolling because again, good properties are going to be coming up on the market that, they're probably going to want to buy and keep and rent out. So.
Yeah, the one great thing about 1031 exchangers, and everybody has the potential of being a 1031 exchanger if they own any kind of investment property, is you guys as brokers, you should never underestimate the power of the service that you can provide these people. Because when you can solve somebody's problem, so if they have a difficult property or a difficult tenant, and you can help them get that sold and get them into something else that is maybe performing better or is in a better location or whatever, that client is going to be a client for life because you solved a huge problem for them and they didn't pay any tax. So there's probably no way you can overstate how important your role is with respect to these investors, because the reality is that they're not going to know enough about 1031. They're going to kind of know the 45 and the 180 days. That's going to be about all they know. So they're going to depend on you to kind of help them get from point A to point B where you can actually solve their problems. But once you do, and once you start working with investors, you would be shocked. You solve a big problem for an investor like that, I guarantee you he knows 5 other guys that he talks to down at the gym or something that are people that own investment property and say, hey, I have a guy that solved my problem and you can call him and he'll take care of it. You won't have to pay the tax and you'll end up in a better property anyway. So that's a great point.
Yeah. And for us, it's about being the resource, not the source. So we want to be able to say, hey guys, I thought this would be helpful. I wanted to invite you, to this because it's really going to be helpful for your business. And then again, they're going to be like, wow. And it's not like, Thomas is here to steal our business. He's not in real estate. He's not interested in that, but it would be awesome to connect it because then we're the one that has those connections. And when you have other connections, people really will keep coming back to you all the time.
Yeah. And Thomas, do you just do like the Virginia area or all over the United States?
No, we do transactions everywhere.
Okay.
So it doesn't matter. And it's a very common thing so you just pick a convenient time. You give me a time, you set up the Zoom, we'll set up the Zoom. If you have a bunch of people, if it's just you and your clients, not a problem, because it's amazing if you can understand what the circumstances are it only takes a few minutes to actually walk through the deal and find out exactly how it works, and if it doesn't work, or if it does, and what the alternatives are. But the rewards are so vast because you guys are talking about Virginia. So when you're talking about Virginia, we're talking pretty big money, right? When you're talking big money, you're talking about big taxes and big consequences if people can't pull it off as a 1031 exchange. So it's always worthwhile to invest a few minutes in trying to plan something, because the likelihood is that you can solve a big problem for people. That makes sense. Let's go to my next one here. Let's see. What are the 3 property rule, the 200% rule, and the 95% exception? Those are the 3 rules that you use for identification, right? We already talked about the 3 property rule is the one that most people use, which is you can identify up to 3 properties of any value, right? If you want to identify, what happens if you want to identify more than 3? Well, you can use what's known as the 200% rule. I've really only seen this used where you're going from one large property to a number of smaller ones. But you can use the 200% rule that is basically this. You can identify more than 3, so you can identify 4 or 5 or 6, as long as all those properties that you identify do not exceed more than 200% of whatever you sold. So if you sell something for $500,000, they can identify 5 as long as all of them together don't exceed $1 million. That makes sense? And then there's, even to the IRS, there's an exception to the rule. So if you blow it on the 3 property rule because you named 4, if you blow it on the 200% rule because the 4 you identified are more than 200%, as long as you buy 95% of everything you identified, you're still okay. So you might as well think of it as the 100% exception, because I don't know how you buy 95% of something. So if you identify more than 3 and identify more than 200%, as long as you can buy everything you ID'd, you're still okay under the 95% exception. Does that make sense?
Okay, yeah. For some reason, I always thought the property you identify, like if you identify 3 properties, it means you're going to buy 1 of them or 2 of them, but it doesn't mean you have to buy all 3. Is that correct, or that's
not? Absolutely true. That's true. And that's probably the best way to approach it, is if you can at all possible use the 3 property rule. That's always the easiest and the best to use if you can. But
you're saying those 3 cannot exceed 200% of the total amount of money that.
No, that's the 200% rule. So there are 3 separate rules, right? So the 3 property rule is a separate rule from the 200% rule. So the 200% rule is where you want to identify more than 3. And so you can identify more than 3. You can identify 4 or 5. But once you use the 200% rule, you're capped. Whatever you identify cannot exceed more than 200% of whatever you sold. So if you have somebody who's trading way up, that's not going to work.
So why would you choose the 200% rule over the 3 property rule? Why would someone elect, or is you?
So if I'm selling, so I'll give you a perfect example. So if I'm selling something for $1 million, and I don't want to buy just 1 property, I want to buy several smaller properties in a different area. I'm going to try to arbitrage my Northern Virginia equity into a lower priced market or something like that. Well, if you're going to buy more than 3, you're going to have to be able to identify more than 3. Right. So in that case, you'd have to use the 200% rule, because you're going from one larger property to a bunch of smaller ones. And so you need the 200% rule for that.
So in other words, if I identify more than 3, now I'm automatically in the 200%. Okay, this makes sense. Okay, so you choose one or the other.
Exactly right, one or the other. And then if you blow it on one or the other, you got to hope that the 95% exception works for you.
Okay. Now, wait, one more time. What's the 95?
So the 95% exception is you can blow it on the 3 property rule because you can name more than 3. You can blow it on the 200% because the ones you identified exceeded 200%. But as long as you buy everything you identified, you're still okay. Right?
Okay. Makes sense.
So what are forward, reverse, improvement, think those are?
I am clueless on all of those.
Those are the different types of exchanges. So like what we've been talking about, we probably colloquially think of it as a deferred or a delayed exchange, right? You're all used to, you sell a property and you buy a property and you do it within 180 days. Well, there are other types of tax deferred exchanges. So you may not know it, but it's actually possible to buy before you sell. That's what's known as a reverse exchange, right? And a reverse exchange, I have clients who only do reverse exchanges because you have a lot more control over the property, over the entire exchange transaction, right? Because what's the hardest part in any exchange? Identifying what you're going to buy, right? But if you think about it, if you were in a position where you could write a check and buy that new property, then you already know what you're going to buy. So you've totally eliminated that 45-day gun to your head. You take out all the pressure, you take all the heat out of an exchange. So a reverse exchange is done where you actually buy the new property. Now, the IRS will not allow you to exchange into a property you already own. So technically, you couldn't buy the new property, sell the old property, and call it a backwards exchange. They won't let you do that. So what we do is there's some specific rules and logistics that we use to do a reverse. For instance, you go ahead and arrange your client to buy the new property. We create an LLC. So we would create a Virginia LLC. They buy the new property, but instead of it going in their name, it goes into the name of this LLC. And then that starts your 45-day and 180-day clock. And then in 45 days, they need to identify, what are they going to identify? They're going to identify the property that you're selling. And you know what that is, so that makes it easy. Then later on, when the property you sold sells, the money comes to us, and then two things happen. The first thing we do is we pay them back for the money they bought the new property for. And then we assign that LLC to them, so they now own that new property in that LLC. Does that make sense?
That's pretty smart. I like that.
That's how a reverse exchange works. The one thing you need to know about reverses, though, because there's extra logistics involved and we have to create this LLC according to the IRS. The IRS has some rules for us how we actually have to do that. That's called an exchange accommodation title holder. But they're more expensive. I'll give you an example. So like a regular exchange is like $1,000. A reverse is like $7,500 because of the logistics. But there are a lot of people that the fee is, it doesn't even matter what the fee is. The fact that they can eliminate the hassle of identification is more than worth it to them. So I have lots and lots of exchanges that only do reverses. They could do a regular exchange, but they just prefer to do a reverse because there's no pressure associated with it. That makes sense.
I have a question, Thomas.
Yeah.
So on that reverse exchange, you're probably talking about a cash purchase, right? Because you can't buy in a residential mortgage in an LLC.
Yeah. Usually it's a cash deal. If I don't want to get too far into the weeds here, but if you're in a situation where you need to buy the new property before you sell the old and you need to finance it, there's a way for us to do that as a reverse. But instead of us taking title in the LLC to the new property, we take title to the old property, if that makes sense.
Yeah.
Right. Okay. So there's two ways to do a reverse. One's called exchange first, one's called exchange last. And then that scenario right there, if you need to finance your new purchase, you go ahead and arrange it just the way you normally would. You're going to buy the new property, get a new loan, and then the day before you close that, then you deed your old property to the LLC.
Okay. All right.
That's called
that's when we call you.
That's when you call us.
It looks over my pay grade to figure that out. Okay, thank you.
And then there's ways, there's the non-safe harbor build-to-suit. There's ways you can actually build new property as your replacement property, right? So, in fact, it's possible to go out as far as 24 months in an exchange where you actually build your new dream property, and it takes you several months to do it. It gets a little expensive, but you can still do it on a tax-deferred basis. And that's called a non-safe harbor build-to-suit, if that makes sense. So if you have clients that like I'll give you an example. Somebody that owns a business and they want to build a new warehouse. And it's going to take them a while to do that because you can't get permits hardly in 6 months anymore. But they could actually get their permits, build a new property, and do it as a reverse build-to-suit, and then later on sell their old property. And you can actually do that totally tax-free. So there's a lot of opportunities, lots of different ways to skin the cat here using 1031.
So if I could for a second, Thomas. So two things I want to say. Wait, Christine, back up with me. If I'm buying, I mean, we can buy a residential property that's an investment under an LLC, right?
No, not when you close it. You has to be closing an individual's name, and then you could change it after you buy it and move it into your LLC.
Okay, but
Like
you're
just like if you refinance it, you have to take it out of the LLC and put it into an individual's name, and then you could refinance it.
Oh, I for some reason I didn't know that, but you're right. We've always done it after, but I didn't know that it wasn't possible. Okay, all right. So there's that.
I mean, people do it all the time, you know.
Yeah,
But when they buy it, it has to be in individual, actual people's names.
Okay.
I mean, there is something, I don't know, maybe Thomas can talk about it, because the only thing I've heard from people is they said sometime the title insurance won't cover you if you do that. Is that something that's true?
Well, the one thing I know about exchanging is that, and this is a very important point that you brought up, is it's always best to buy as the same entity in which you sold.
Yeah.
So if you sold something in your name, buy something in your name. Don't buy it in an LLC. You could technically buy it as a single member LLC, which is considered a disregarded entity for tax purposes. But you got to be very careful. Anytime you're in the middle of an exchange, if you manipulate the equity or the debt or the vesting, you're going to potentially cause yourself problems. So if you sold in your name, buy in your name, and then the day after the exchange is done, then do your tax planning or your estate planning and move it to your trust or your LLC or whatever. That makes sense.
I'm loving this reverse thing, and I'm going to tell you why, because guys, I'm just going to tell you right here and now, 45 days, you may have identified a property that you want to buy, but it doesn't mean that it's going to work out. I mean, I can't tell you how many times we've been in the middle of deals, and the higher price they are, kind of the longer they take. The investments take a little bit longer. Land takes even longer. And unless you have an offer and that's been accepted and you've gone through all your contingencies, that deal could fall apart. And now you're in a real bad situation if you're on that time clock. So you got to get moving as soon as possible. So I'm loving that reverse, because if it's done properly, you take that whole craziness out, because one bad move or one wrong situation, you are going to be taxed. Your client is going to be taxed up the yin yang. So I'm loving that. So thank you so much for that, Thomas. That's very exciting, and that's all I wanted to say. Sorry.
Yeah, that's exactly why experienced exchangers prefer the reverse, because the thing that it does, it takes kind of the unknown in terms of logistics and it puts you in control of it, right? So it just takes the one item with respect to identification that's always the unknown and is always the thing that causes everybody stress, and especially you guys. And it just takes that out of the equation, because then you can just concentrate on getting the logistics done and getting the property closed. That's why reverses are becoming more and more popular. Make sense? So what is buy equal or greater in value, move all your equity from the old into the new, and replace your debt? That's the cheater's math that I was talking about earlier, right? So these are the only three things you need to know about 1031 exchange math. And I'm going to swear you guys to secrecy. If you promise you never heard it from me, people will think, man, I wonder where'd that guy get his CPA from? That guy is incredibly good with his math. So the reality is this: if you want a totally tax-free deal, these are the three things you need to do. Buy equal or greater than your net selling price. And the reason I say net selling price is because you can include your non-recurring closing costs on the sale as well as the purchase in your 1031, right? So technically, you should be able to buy, sell, and then buy and not come out of pocket one dime and still have a totally tax-free deal, right? And so the way you do that is you buy equal or greater to your net selling price. So that's the number you want to hit. So if you sell something for $1 million and 50,000 of it is closing costs, you want to hit that. You want to try and get close to that 950 number on your replacement property. Then the second thing is you want to move all the cash, all the equity from the old property into the new property. And then 3 is replace your debt. So if you have a $100,000 loan on the old, make sure you have at least a $100,000 loan on the new one. And if you do those 3 things, you know it'll be tax free. So to the extent that they trade down in value, so you sold for $1 million and they bought something for 900, you know they're going to probably owe some tax on the difference, right? If they sold for $1 million and they put 100,000 in their pocket, you know they're probably going to pay tax on that. That's called cash boot, right? And then if they had a $100,000 loan, but they don't get a $100,000 loan on the new property, you know they're going to probably be taxed for debt relief, right? Does that make sense? So that's the cheater's math in 1031.